What's up guys, it's Dennis. In today's video, I'm going to let you in on a not so well-known tax strategy for retirement planning and one of my personal favorite savings accounts, and that's the HSA accounts. HSA accounts have been around since 2003, and although pretty mainstream, a lot of people don't realize what you can actually do with them. If you use your HSA account correctly, it's an account that is triple tax advantage. And we'll get into that a little bit later as to what defines it as triple tax advantaged. It's no secret that healthcare in the US is extremely expensive. In fact, the average individual and family spends about $7,470 and $21,342 per year in health insurance. Although this might seem like an outrageous cost, if you actually get hit for some of the healthcare bills and not the insurance, you'll be paying significantly more than that. In fact, in the last year, my family spent over $50,000 in bills as a result of routine medical expenses. Now, no one in my family has a chronic illness or anything like that. It was just run-of-the-mill stuff that you would encounter as a family. However, because of our insurance and specifically the high deductible plan, we were only on the hook for about $5,000 for the year, which really isn't that bad in the grand scheme of things. A couple years ago, I had no idea what an HSA was or how to use it. I always thought that it was a lot riskier than traditional insurance, and I didn't really realize how tax advantageous the HSA really could be. After crunching the numbers, I realized I was leaving a ton of money on the table by not investing in the HSA accounts. In fact, generally speaking, by not using an HSA account, you could be losing out in years of compounding in a retirement account that is specifically designed to grow as you get older. If you watch this video all the way through to the end, I'm going to reveal a ninja strategy that can grow your HSA accounts even more. Speaking about investing for retirement, you can invest in your financial future by smashing the like button for the YouTube algorithm. And while you're at it, you can destroy the subscribe button and the notification bell. That'll really give you a head start in your retirement journey. And the best part of all, it's totally free to do so. An HSA account is a health savings account. Now, what does that mean? Effectively, it's a savings account that's designed to help you pay for qualifying medical expenses. As a result of its purpose being specifically designed for medical expenses, it's tax advantageous to use it. What that means in a nutshell is that it works just like a bank account, and whatever you contribute to your HSA, or if your HSA grows, that money is yours to keep, which is different to an FSA, which it's more of a use it or lose it tool. Now, here's really the fine print when it comes to an HSA account. To be eligible to have an HSA, you have to be enrolled in a high deductible health plan. Now, in my experience, that's the very reason why people shy away from an HSA or high deductible health plan. They hear the words high deductible and that scares them away. In fact, that's the very reason why I didn't invest in an HSA from the get-go. I thought that you'd have to pay a ridiculous sum of money, which is totally unaffordable, and it wasn't capped by anything. Turns out that's not necessarily the case. As the name suggests, high deductible just means that you have a certain deductible that you have to meet until everything in plan is covered at 100%. Congress has put certain limits as to what can be defined as a high deductible health plan, and it gives various thresholds as to who can qualify. Looking at the charts for 2022, the minimum deductible is $1,400 for an individual and $2,800 for a family. Note that I said the minimum. Now the maximum is $7,050 for an individual and $14,100 for a family. What this means is any deductibles, co-payments, or co-insurance will first go towards your deductible. Once you've hit that deductible, you won't pay anything more as long as your expenses are considered in-network. This is fondly referred to as the out-of-pocket maximum, and it's effectively the maximum amount of money that you will pay in any given year for health insurance. Now, that doesn't necessarily mean that you'll be on the line for the full amount that's been set by Congress. Different insurance has different limits based on the different company plans. So as an example, for me in my situation personally, I had a family covered and my insurance said $5,000 was the out-of-pocket maximum. So practically that means is that I will pay almost 100% of the costs up to $5,000. after which my insurance kicks in and they will cover everything at 100%. So when you're thinking about an HSA as a bank account to use to put towards medical expenses, you want to think about what your out-of-pocket maximum is, because that's realistically what you could be on the line for in any given year. Now, if you are at an employer where they do offer a high deductible health plan and an HSA combo, very often they will try and push you towards these options. And there's a number of reasons for that. One of the reasons that companies do like to push people to move to the high deductible plan is it's cheaper for them. However, I see it as more beneficial for the employee than the employer. Now, the employer does get a tax deduction as well for any amounts that they contribute towards your HSA, and we'll talk about that a little bit later. However, they also get a deduction for any premiums that they're paying as well. And generally speaking, these premiums are less than what it would be for ordinary insurance. Said another way, it's a win-win situation for the employee and the employer. Speaking about tax deductions, every dollar that you contribute towards your HSA reduces your taxes. Now, that's one of the first tax advantages of the HSA account. It works very similar to other retirement contributions like a 401k. Every dollar you put in, you can claim as a deduction on your taxes. However, there is an annual limit for the HSA accounts, and depending on whether you're filing as single or you have a family plan, there are different limits that will apply. So definitely be sure to check the latest tax rules. For 2022, the annual limit is $7,300 for a family, which is what's applicable to me. Some employers will also contribute to your HSA. So in my situation, my employer contributes $1,200 every year that I'm enrolled in the HSA. What generally happens is that amount is paid in January of each year, so you get the money up front. It's basically free money, so it's worth inquiring with your employer as to whether they offer something similar. Okay, so you've decided to bite the bullet and take on an HSA. So what does it mean and how does it exactly work? Well, your HSA is managed by a custodian, and we'll talk about that in a little bit. But effectively, it's a third party that manages the account for you and is responsible for actioning any requests such as withdrawals or contributions to the accounts. Normally, your employer will withhold an amount for you and automatically make the payments to the custodian. So if you do have any medical expenses, how do you use your HSA? Well, you have three options. Option one is going to be to use the HSA to pay for medical expenses. And to be honest, this is the option that most people use, because isn't that why we have an HSA, to pay for medical expenses? And yes, that is 100% true. We do have an HSA to cover any medical expenses that we have in any given tax year. However, one thing you want to keep in mind is that you need to keep all your receipts in order to claim them back as a deduction. So the way I think about this is any amount that I'm actually paying as a payment towards anything medical, you keep the receipts for, and you can claim that back when you withdraw from your HSA. The second option is to use your HSA to pay for non-medical expenses. So earlier I said it's like a bank account and you can withdraw money at any point in time. However, when you withdraw money and it's not for a specific medical expense, generally speaking, that money is going to get taxed and included in your taxable income. So you kind of lose one of the benefits in putting it in an HSA because you're going to get hit with taxes. The third option is what I do and what I tell people to do, and that's use your HSA to invest in the stock market. Now, why would this be my favorite thing to do instead of claiming medical expenses on my HSA? Well, it's actually the third tax reason for the HSA, and that's that any money that the HSA account makes is completely tax-free. So if you were to take your HSA contributions and invest in something like the broad market fund, SPY, you would get exposure to the general stock market, and you're almost guaranteed to get an 8% return year over year. Now, I'm not saying you will get an 8% return year over year, but generally over a long period of time, that's what the market will return. Now, this graphic depicts how an HSA compares to a traditional retirement account. As you can see, with an HSA, the funds go in tax-free, they then grow tax-free, and they are finally distributed tax-free, provided that you claim your distributions as qualifying medical expenses. If this account is used correctly, you can save a ton of money on your taxes. Now, you might be thinking, well, you may be using that account to grow money, but you had real expenses in that year. How did you pay for them? And to be honest, out of pocket's the way to go. I normally fund that straight out of my paycheck. And yes, it hurts to do that because it's money out of the door. However, The benefit of it is that the money in the HSA, you can use that money at any point in time to claim your medical expenses. So what I could do is I could incur something in 2022 and then in 2025 claim that as a withdrawal from the HSA account, and it's completely tax-free. Now, I will say that you have to keep really good records for this. So you want to make sure that you keep a record of all your expenses. What I do is I use a cloud sharing service, something like Dropbox or iCloud, and I found that works really well to keep everything in one spot. It really blows my mind that HSAs are structured this way, but they are in fact the most powerful tax advantage retirement accounts that you can use, provided that you use it correctly. I mean, take a look at a 401k as an example. So your contributions to the 401k, sure, they're tax-free and you can claim a deduction for that in the year that you contribute. However, generally speaking, when you withdraw from that 401k, you're going to get hit with taxes versus the HSA where you're not going to get hit with taxes and any gains are not going to get taxed either. So it really is a really powerful retirement account. Now, you may be in a position where your HSA custodian doesn't offer good investment options, or there may be a fee associated with investing. And this is a situation that I ran into with my employer. The custodian that they had elected charged a $3 monthly fee to manage the investment. And then they also didn't have really good options. So I decided to switch to another provider. One thing you can do is a rollover, and you can move to any other HSA provider. One caveat though, you can only do this once every 12 months. So make sure that you do it at the right time. To solve this issue, I try and max out my HSA in January of each year because I get the employer contribution right off the bat. And then my contribution, I try to get as much money into that account as possible before doing a rollover. That way I roll over the entire balance. I've personally found that Fidelity has a really great HSA option and they don't charge a monthly fee. So you can definitely check them out. This is not a sponsored video, but it's a provider that I use and I really like them. In closing, HSA accounts are extremely powerful retirement vehicles, and I urge you to check them out and do your own research, figure out what you can do with your finances. Obviously, different people's situations and circumstances will change, and it really depends on an individual by individual basis as to what you should do for tax planning purposes. For those of you who stayed to the end of the video, I will say that there's one other thing that you can do in an HSA, and I'm not saying you should do it, but you can even do options trading in an HSA, which further proves what a great retirement account it is, that you can get really creative, and if you know what you're doing in the markets, you can really get some good return. Thanks for watching the video today, guys. If you liked the video, please give us a thumbs up, and also don't forget to subscribe to the channel. We're just starting out, so any subscribe really helps the channel a lot. Thank you and have a great day.